Our third example involves the concept of deferred revenue, or the accounting convention of recognizing a liability for prepaid revenues or getting money up front before you've earned it. Remember that the broad definition of a liability is something that you owe in the future. Therefore, when you receive something that you have not yet earned, you have a liability or obligation until it is earned. So in our third example, we are going to create a scenario where you get money up front in one period and earn it over the next period. So for example, let's say you have a training business and you receive upfront payments of $2,100 from several students in the month of January 2013 for a class in February 2013, and record each transaction as a sales receipt using your standard items where training revenue is recorded when a sales receipt is entered. Assuming you are accounting under the accrual basis where you match revenues and expenses in the period they relate to, if you record the above-mentioned receipts in January, then you will have recorded sales in the wrong period, since the class will not be until February, which is the period you will earn the money you received. However, since you did receive the money in January, you need to record that the money was received, and if you wait to record the sale receipts until February, then the money you received will not be recorded in the right period. So on the surface, it seems like you are in a dilemma, since no matter what you do, you are wrong in some way if you use the normal ways of recording a cash sale via the sales receipt function. Well, fortunately, the Make General Journal Entry function allows you to rectify the situation and get the accounting right. First, let's open up a new journal entry by going to Company, Make General Journal Entry. Since we indicated sales were overstated in January by $2,100, the correcting entry we know must reverse these sales in January and then recognize them in February if we record our sales receipts in January. So if we know that this entry is going to have a debit and therefore credit of $2,100, as this is the amount we are dealing with, so let's put $2,100 in the debit and credit fields for this journal entry. Now the question is, what account should we debit and what account should we credit? It's time to go to our debit-credit matrix, which we discussed in our first two examples, to see which way to go. Now, since we know we have to reverse or decrease the sales in January for $2,100, if we look at our debit-credit matrix, we see that we need to debit our sales to decrease income or sales. So what's the credit account that you should use for the other side of the transaction? Well, let's think about this for a minute. Since we need a credit, and if we look at the debit-credit matrix, let's try to work this through. The nature of receiving something like money up front for a future sale creates a liability that needs to be recognized. Deferred revenues is a commonly used account to identify such a liability. So if you look at the debit-credit matrix, you will see that to increase a liability is a credit, and the deferred revenue account just mentioned fits the bill to complete this transaction for January. We can go ahead and save the journal entry transaction at this point, but before we do, let's consider what should happen in February. Remember that we have a liability at the end of January for the money received that won't be earned until February. But once February comes along and we complete the training we were paid for, shouldn't the liability be relieved and the training sales recognized? We could make another journal entry in February to perform this task, but another option is to create a reversing journal entry, which in effect reverses a transaction we set up in January. The way it works is you can click on the taskbar and the icon called Reverse, and the first thing that happens is you are prompted to save the first entry, and when you say yes, then a new entry appears that is dated on the first of the following month of the original journal entry, and notice the same accounts are shown, but with the debits and credits reversed from the original entry. So in our case, the training sales are now being recognized in the right period, as evidenced by a credit, which increases training sales, and our former liability, deferred revenues, is extinguished via debit as we fulfilled our obligation by providing the training class. The ability of using journal entries in QuickBooks provides you with the unlimited ability to make your accounting right whenever you run into a situation that the normal functions in QuickBooks appears to paint you in an accounting corner, especially when it comes to transactions that relate to more than one period, requiring allocations to be made over multiple periods. The tricky part is many times knowing how to do the setup and understanding clearly what is going on in a given complex situation. When it gets too tricky, you certainly want to seek the advice of a professional accountant, but for more prosaic type of transactions, learning to use journal entries effectively can pay some nice dividends.